Welcome to the Yaka Digital Network videos. Whether you are running a busy stall in a Wino market or managing a rural farm, doing business in Uganda comes with a guaranteed reality. Unpredictable risk and unexpected losses are inevitable. Imagine spending years carefully building up your inventory, only for a devastating fire to break out and wipe it all out overnight. Look at two financial ledgers facing this exact disaster. On the left, the loss is total. The business is permanently closed. On the right, the balance dips but instantly rebounds. This recovery stems from a formal financial mechanism catching the business before it falls. We call this a catastrophic loss, a financial hit so severe that it completely exceeds an entrepreneur's personal savings or emergency borrowing capacity. Without a financial safety net in place, a single severe event destroys both the current business and the entrepreneur's future. Insurance is the tool built specifically to solve this problem. It allows a business owner to transfer the massive burden of unpredictable risk away from themselves and into a collective pool. It converts the threat of total financial ruin into a manageable, fixed operational cost, allowing the business to survive unexpected disasters. Think of insurance like a large-scale community emergency fund. Just as a village collects small amounts of money to help any member who suffers a disaster, insurance scales this exact logic up. Picture 100 businesses, farms, matatus, and shops sending small amounts into a central vault. This regular payment is the premium, keeping protection active. Connecting each business to that vault is a legal contract known as the policy, defining what risks are covered. Now, let's introduce a risk event. Operating in dense traffic carries high exposure, and one of those insured commuter taxis suffers a severe collision. The owner submits a claim, a formal request for promised financial help. The insurer releases an indemnity, the exact compensation needed to restore operations. This massive payout is possible because it's funded by the small premiums of the 99 other businesses that did not crash. A common misconception in Uganda is that if you pay a premium and never make a claim, you have lost your money. Insurance is not an investment fund to draw from. You are buying guaranteed peace of mind and business continuity. If we zoom out from individual businesses, we can see how this risk pooling stabilizes the entire national economy. Insurance companies aggregate massive amounts of capital. Instead of letting those premium pools sit idle, they invest them into long-term infrastructure and national development projects. It also acts as a bridge to credit. Banks are highly likely to lend money to an entrepreneur if their business assets are formally insured, because it reduces the risk of default. Yet, despite being a cornerstone of a stable economy, formal insurance adoption in Uganda faces a massive deficit. As this map highlights, formal insurance penetration across the country hovers around a mere 1%. Instead of formal policies, the vast majority of Ugandans rely entirely on informal risk-sharing networks, like village savings and loan associations or SACCOs. This protection gap exists for clear reasons. Widespread public skepticism about whether claims will actually be paid on time is paired with a general lack of insurance literacy. Furthermore, traditional, rigid insurance products are often a poor fit for the daily realities of small-scale or informal sector workers. To fix this, the market is turning to insurtech and microinsurance, new models designed specifically to be flexible and affordable. Take weather-indexed crop insurance, for example. Instead of relying on complex manual field investigations, payouts to smallholder farmers are triggered automatically by regional rainfall data. Bridging the protection gap requires innovating products that actually fit the informal Ugandan market, rather than forcing traditional models upon it. When an entrepreneur does enter the formal market, they must match their specific vulnerabilities to the right type of policy. This matrix breaks down the 4 most common commercial insurance policies available in Uganda. First is motor insurance. Third-party coverage is a mandatory legal requirement for any vehicle on the road, protecting others if your vehicle causes harm. Second is fire insurance. This protects physical business premises and valuable inventory from fire-related destruction. Third is agricultural insurance, backed by schemes like the Uganda Agriculture Insurance Scheme. It shields farmers from the financial fallout of crop failure or livestock death. Protecting agriculture through insurance ensures national food security. It keeps farmers planting next season, even if this season's yield fails. Finally, we have life assurance and WEBA coverage. Life assurance secures dependents financially if a primary breadwinner passes away, while the Work Injury Benefits Act covers medical costs if an employee is injured on the job. By understanding these distinct categories, an entrepreneur can build a customized shield around their most critical assets. To see how all of this connects, let's review the complete timeline of risk transfer. This chart details the formal cycle. It begins with identifying risk, then making a premium payment to secure a policy. When a loss occurs, you file a claim, triggering the indemnity. The entire mechanism exists to guarantee the claim inevitably leads to compensation. By incorporating insurance into a business plan, an entrepreneur builds the structural capacity to survive the unexpected while pursuing success. You can watch more videos for all classes here and get all content at www.yaka.cc.